Thank you for joining us. You're listening to the Beyond 50 radio program. I'm Daniel Davis. Today we're going to be talking about something that probably a lot of us aren't as prepared for as we think we are, and that is retirement planning. Joining us here on the Beyond 50 radio program today is a 25-year industry veteran who began his career with Shearson American Express in 1984. He then founded Rogers & Associates in 1996 to help families create and conserve their wealth in preparation for worry-free and dignified retirements, which is exactly what many of us want to do, especially this day and age. I'd like to welcome to our program today author of the new book, The New Three-Legged Stool, A Tax-Efficient Approach to Retirement Planning. And our guest today, Mr. Rick Rogers. Mr. Rogers, thank you for joining us here on the Beyond 50 radio program.
Good afternoon. Thank you for having me.
You know, you've got to agree that in this day and age of information, sometimes people just feel like they're being pulled in every direction about what the right thing to do is when it comes to retirement planning in such a way that it just simply becomes confusing. But I like the perspective that your book puts into, and that is simply, it isn't a matter of how much you make or how much you grow, but it's a matter of how much you actually get to keep, and that should be key.
It should be. When I thought about writing a book on retirement, just on retirement, gosh, you know, what part of it do you skin first?
Right.
Or try to put it all into one book? And so I decided just to focus on the tax efficiency here, which I think is probably one of the most important parts of retirement.
You know, that's so true. I know that over the years that I've been reading about not just investments but also financial planning as well as retirement planning is that's one of those things sometimes I don't think people are aware of. You know, they worry about how much does their money grow, how much does it stay ahead of inflation, but the real hardcore issue really is the tax liability that you have and how to avoid as much of that as you can. Now, could you tell us about your company's mission and why you decided to write this book?
Well, we are focusing on efficiencies overall in the area of finances. Because most people, they have somebody that prepares their taxes. They have an insurance agent that advises them in insurance. They have probably somebody that's advising them on investments. They might talk to a banker about debt management, but nobody's really coordinating it and making sure that it works together efficiently. Mm-hmm. Do you have the right insurances? Do you have insurances that you no longer need? Are your investments working together to minimize taxes? Have you done everything ahead of time to prepare for lower taxes? Because your accountant really can't do a whole lot for you when it's April and we're filing last year's returns. And so that's what we focus on, is on making sure that all the pieces are together, all of them are working efficiently from a tax perspective, from a risk perspective, and from a cost perspective. Just trying to be the individual's chief financial officer. And
now,
so the book,
go ahead, sorry.
And so the book focuses on one thing that we do, tax efficiency and retirement planning.
Ah, very good, which are very, very, very important, as a matter of fact. Now, you know, that's interesting because you've been in this in the financial industry for, you know, at least 25 or more years. So I'm sure that you've seen a lot of common consistencies as far as mistakes go that people make when they plan their retirement. Could you tell us about those?
Yeah, I guess the one that we hear a lot about in the financial press is not saving enough. It doesn't seem like more than a couple months go by before somebody does a poll on especially baby boomers, so the beyond 50 crowd, that have we saved enough and we're not saving enough, and the average person has such small amounts. And that probably is the biggest mistake. We don't save enough or we start too late. But I would think the second biggest mistake then is not saving efficiently from a tax standpoint, because what we hear is defer, defer, defer. And probably for my entire career, that was an important thing to do because tax rates have come down for the last 25 years. But that's probably not going to happen the next 25. We're probably looking at a round after round of tax increases. The most recent one being in the Healthcare Reform Act, increasing taxes for certain individuals. But we're not just going to be able to cover these deficits on the backs of 5% of the population. It's going to trickle down to everybody. And so I think a different mindset about retirement planning needs to take place today, and that being preparing now for when you're retired, you're not going to be in a lower bracket.
I know in your book, The New Three-Legged Stool, when you talk about deficit, that's one of the key things that really changed the game in some ways, is that, you were saying in your book that an average of $55,000 is owed by each family in America for the debt that the government has basically created, and you think to yourself, my goodness, how do you even protect what you have if these guys are looking for ways to get themselves bailed out through our tax dollars?
Right. And who's going to pay that? And
right.
It's going to be you and me. It's going to be our kids. It's going to be our grandkids. And 55 is probably a low number because I wrote that book before the financial crisis in 2008. So everything's ballooned since then. Mm-hmm. Yeah, big numbers.
Big numbers. Now, your book is titled The New Three-Legged Stool. Describe what that means for us.
Well, we need to go back to 1974, and the government back then passed a law called the entire Employee Retirement Income Security Act that we fondly refer to as ERISA. And ERISA was about standardizing rules for pension plans because at that time, back in the 70s, we didn't have IRAs, and basically your retirement dollars was, if you had a retirement plan, it was your company's pension plan. And so what was referred to as the three-legged stool of retirement was that you needed a company pension, you needed Social Security, and you needed some personal savings. Those were the three legs. Well, now in 2010, company pensions, if you still have one, are probably on the way out because I don't think any company is putting in new pensions, and it's probably only public employees. Social Security, well, talking about the deficits, that's a big one there. Mm-hmm. I think it's, I don't know how many trillion of unfunded liabilities for Social Security. And so now our three legs are tax-free savings, which is your Roth IRA, tax-deferred, which would be your IRA or your 401k, and after-tax, which would be what you're saving in a savings account, a personal investment account. Our new three legs.
Mm-hmm. Now, it's interesting as I was reading in your book, The New Three-Legged Stool, is that I was reminded of a story, and it was at the part where you were talking about, how to properly roll over your IRA or your 401k plan, so that way you really don't get hammered. And just that very thing actually happened to a friend of mine a few years ago where he was leaving one company to go work for another, so he had to actually pull his money out and ended up with a tax bill of $35,000 plus, for trying to do the right thing. And I was like, well, where did you go wrong from moving it from point A to point B? And this is somebody who, watches financial news and the like, but even being as educated as you think you are, there are a lot of little details you need to pay attention to. And it can get kind of scary out there.
Right. I like to tell the story of me remodeling a bathroom. Now, you might think a financial planner, what does he know about any of that? But, in another life, as I was going through high school, I worked in construction and did some carpentry. I did some bricklaying. I did some wiring. I did some plumbing. So, I'm familiar with tools. And I would think that as good as any average homeowner out there, I know something about tools and something about remodeling. And I was doing this bathroom, which was just a little powder room, really, and upgrading some of the fixtures and so forth. And I got to the point where I was hooking up the plumbing, and I could not get the leaks to stop. Not big ones, but I put this thing together, took it apart, went to Home Depot a couple times, got parts, and after a while I was just so frustrated. What was supposed to be a one-weekend project took 2 weeks, and I ended up calling a plumber who had it fixed in like 10 minutes. Mm-hmm. So the little tricks of the trade, the little things that you don't know, even if you've done some reading, even if you've seen it done, you just get missed. And when you have big decisions like a rollover, it doesn't hurt to get somebody who knows what they're doing. Mm-hmm. To give you some advice.
As they say, it's $1 for the advice about what's wrong, but it's $4,000 to know how to tap the hammer in the right place.
Right, that's right. A good analogy, yes.
Now, you brought up Social Security earlier, and you say this should still be a part of your retirement plan, but you always hear the bad news about how by the time we retire, especially the boomers today and even in the next generation, that won't simply be there, but you suggest that there are ways that we can maximize Social Security benefits. How can we do that?
I think the first thing would be to review your statement that you get every year or every other year. So many people get these things and they look at the number. Okay, I'm going to have $1,500 a month or $2,000 when I retire, when I reach full retirement age, and they throw it in a drawer. But on the second page of that, well, that's actually page 2. Page 3 then has a list of all of your earnings that Social Security has. So I think everybody, as a homework project, should pick that statement up and make sure that the wages that they have recorded are correct. Because if they aren't correct, it's easier to get them fixed now than if you realize 10 years down the road, because you're essentially going to have to document what your wages were and get Social Security system to fix that. Now, you don't see that very often, that they make mistakes, but they do make mistakes.
Mm-hmm.
And so you want to get credit for everything that you've paid, and that would be the first place to start. The second thing is that Social Security has penalties and rules, particularly between ages 62 and 65. So if you're thinking about maximizing your Social Security and you are no longer working, you need to make a decision about whether to draw at 62 or wait until I'm 66, which is full retirement age, because there's going to be a discount. And I have a whole section in the book on how you make that decision without trying to go into a lot of detail today.
Mm-hmm.
But that's probably one of the biggest areas to maximize your Social Security, because if you're still working, you're going to be penalized pretty severely for drawing before 66, and you don't want that. Mm-hmm. The other thing is that especially for people that leave the workforce at some point in their career and then return, Social Security looks at your highest 35 years. And so they look over your entire work history, and if you have some zeros in there, even working a part-time job to get rid of a zero or two at the end of your working career is a good idea. It can make a pretty significant difference if they pick up a $15,000 part-time income for 1 year and drop off one of those zeros. Mm-hmm. So those are some of the things to look at before you start drawing.
Mm-hmm. Now, you talk about in your book at length about IRAs, the types of those, and 401k plans. Now, describe why people who have those available to them through their company should participate.
Well, you might get the impression as you read through my book that I think that those are bad ideas because it's tax deferral, so you're putting money off to when you're going to maybe pay a higher tax. And while that is potentially true, you always have to look at the trade-offs. So should I make an IRA? If I can deduct an IRA contribution this year, should I make an IRA or should I make a Roth? Because if I make an IRA contribution, I get immediate tax benefits this year, where if I make a Roth, I don't get any tax benefits until down the road when I'm drawing money out and it's going to be tax-free. And so we're always looking for the trade-offs. So I get a benefit now, but I'm going to give up the benefit. And so there needs to be a balance, which is why 3 legs, not just one leg, not just one tax-free leg, but a balance between the 3. The other thing about your 401k is it's probably the easiest way to save. They take it out of your check. You don't see it necessarily. You get used to living on what your take-home pay is, and so it's probably the easiest way to save. And so if I had to advise somebody on, put money into a 401k or don't save at all, it's better to have it into the 401k so at least you have something for savings. Mm-hmm. So I think that we don't want to ever exclude those types of plans. There needs to be a balance, and it's not as easy to explain how to come to the right balance, but it has to do with where your tax brackets are and where you're starting to lose deductions, and all those things factor in as to whether or not I want to put more money into my 401k or into my Roth.
Now, you talk about retirement distribution. If this is the key to the point that you've amassed this money, how is it going to be allocated to you? What are the best strategies you can use as one of the key elements you're talking about is the Internal Revenue Service, how much they get and how much you get to keep. So let's talk about that factor and how to use it to control taxes.
Okay. Well, one of the great things about retirement planning, being retired, is you can plan your income if you've developed all 3 legs. So think about it as you're working. So how much control over your taxes do you have? Probably not a whole lot. So let's just say, hypothetically, you make $100,000 in wages. If your company has a 401k, you could put some of those wages into a 401k and minimize your taxes. But what do you do after that? Take a pay cut? That doesn't make much sense. I don't think people would sign up for that. So, there you are stuck with wages, and you've got to pay Social Security tax on all of those. You have to pay federal tax, state tax if you're in a state that has state tax, local tax. Where I live, we have a local income tax. Some have higher taxes, but I mean, essentially, wages is the worst taxed income because it's subject to all the taxes. Mm-hmm. Now we're retired, and we have Social Security, which is partially subject to tax, pension, which is all subject to tax, and we have our personal savings. And our personal savings, if we've saved it properly and it's balanced, now we get to choose how much taxable income that we have from our personal savings. And I think in the book I talk about trying to come up with $40,000 of income, and you're taking, or $30,000 because that divides equally, and we take 10 of it from the taxable account, 10 of it from the Roth, and 10 of it from an IRA account. The amount that comes out of the IRA is all taxable. The amount that comes out of the Roth is all tax-free. And the amount that comes out of a taxable account, we've already paid most of the tax on that, so you would only have minor tax implications. So essentially you have $30,000 of income, but you're only paying tax on maybe $12,000. Now, if we bring this all into your personal situation, and what other income do you have, what are your deductions, we can pretty much determine how much tax, if any, that we want to pay each year by selecting from the three legs. How much income comes from each one.
As they say, it's not a matter of how much risk you can tolerate, it's a matter of how much you can actually manage.
Right. That's right.
So as you were saying.
Yeah. Mm-hmm. And so you have all this control over your retirement income if you've saved it properly. Mm-hmm. But now let's say that we have $1 million that we've saved for retirement. So $1 million, that's $40,000 in income. But how much of that do we really have if I've saved my entire $1 million in my 401k? All of it's going to be taxable. So the whole $40,000 is going to be subject to tax when it comes out. What about if I saved it all in a Roth? Well, that would be great. That would be best. Now $40,000 is all tax-free. But look at what we have given up along the way, because we didn't put anything in any tax-deferred accounts. We paid a lot more taxes along the way, so there's that lack of balance. If we saved it all in an after-tax account, we've been paying some of the tax along the way. Some of it's going to be subject to tax. But $1 million is not the same value, depending on where you've saved it. Mm-hmm. A balance.
Very good. Yeah, it makes sense, because you hear so much in the financial news today that just, again, it has everybody just being torn in every which way but loose, and they get to a point where they really don't know. But it's also, as you read through the new three-legged stool, it's about just exercising common sense and asking good questions from your financial planner to be able to achieve the kind of goals that you're talking about here. And
it's so personal. Mm-hmm. I don't want to.
There's a real one-shoe-fits-all thing going out there, isn't there?
Right. And I think the financial press needs to take that approach. So they come up with these rules of thumb that you've heard, but I mean that's what they are. They're rules of thumb, and everybody has a different situation, a different tax situation, and even from year to year, your tax situation can be significantly different. In 2008, for example, pretty much eliminated any capital gains that anybody had to worry about. So that created an opportunity in 2008 and 2009 to do Roth conversions, to take capital gains that you would not have been able to take before because everything else went down, and so incomes were lower. So you need to well, I don't want to say take it with a grain of salt, but recognize that what the financial press is doing is trying to give you the advice that would be applicable to the average person or to the most people. But specifically in your situation, it may not apply at all, or it may apply completely differently. And keep that in mind.
Exactly. Now, let's talk about examples of what good retirement plans consist of, sort of the core elements, if you will.
Okay. In order, I think the very first one would be that you need to have a budget. I know people hate that. And so substitute budget for a cash flow plan.
Make it politically correct or incorrect, however it works for you as an individual.
Yeah, you need, that is so important because most people don't really have an idea of how much they spend every month. Mm-hmm. Or so before we can properly plan, before we can do any kind of retirement planning, we need to know how much how much it's costing you to live today, and what adjustments, if you're not retired, what adjustments are going to be made when you retire. You talk about the financial press. Here's one that you hear all the time: 70%. You plan for 70% of what you spend today. Mm-hmm. And I found that to not be true at all. You plan for 100% of what you're spending today for the first 10 years of retirement. And then after you retire, then your income would go down, or your spending needs would go down. But not for the first 10 years. They just change. You do things differently. So that's how we figure in. But how can you plan for that if you don't know? And you won't know unless you have done some budget protection. So, know how much that you're spending. I had a situation with a client who I had been working with for 10 years, and he was offered an early retirement package, and everything lined up right. And so we took the early retirement package, and 12 months later, after everything seemed to be going good, he said, I need to take a lump sum of money out. He said, my credit card bill is too big, and I can't handle the payments anymore. And I said, well, did you have a big expense? Was there something unexpected? Because I hadn't known anything about a credit card. What they were doing was that every year they would overspend month after month, and then he would get his bonus in March, and he'd take his bonus and pay the credit card off. Well, we were planning on what they were spending, what we thought they were spending, but they continued to spend using the credit card, and now there's no bonus in retirement. Well, what a crimp that puts into your retirement plan.
Right.
So now he's out of work for a year, he's retired, and now we have to revamp everything, and the money wasn't quite what we wanted it to be, and he ended up working part-time until we could get the spending under control. So first thing is to have a budget. Cash flow plan if you prefer. Know how much you're spending every month and what adjustments might be made in retirement. And unless you're planning to retire tomorrow, I would put into my retirement plans that what I'm spending today. If it turns out that you're one of those people that spends less in retirement, we're so much more conservative. And then the second part of a core element would be to have sufficient savings. So how do we figure that out? Well, if we know what we're going to spend, and we know how much Social Security is going to provide, or how much pension is going to provide, we come up with how much is going to be needed from your investments. And take that amount per year. So again, if we're using $50,000, so $50,000 is what we need to spend from, or we need to take from investments. Take $50,000 and divide it by 4%. And that's how much we need to have at minimum in savings. So $50,000, you need $1.2 million. Because going into retirement, we don't want to be planning to spend more than 4% of our investments. Mm-hmm. If you look at any kind of historic returns going back over 10-year periods and rolling 10-year periods, a 4% withdrawal rate is a sustainable rate, assuming that we have at least a balanced portfolio, meaning half in stocks and half in bonds. So we want to have sufficient savings, and that's the way we arrive at it. You can add inflation to it. There's other ways, but just to be simple for your listeners, that's an easy way to figure it. 4% of what you plan to spend. And then the third element would be to have an investment strategy to make sure that the money is going to last forever. And an investment strategy really should be based on a balance between stocks and bonds. Some people think that stocks are lousy after 2008 and 2009, but it's still the best investment that there is. It's still the only investment that keeps pace with inflation. And so, like it or not, we need to have at least half of our money invested in stocks. Mm-hmm. Now, it should be a broad portfolio, broadly diversified. Use mutual funds, which is what we do, to keep it broadly diversified instead of individual stocks. But stocks over time is the only thing that has kept up with inflation and actually exceeded inflation. You can't go into 30 years of retirement with a fixed income portfolio, or each year you'll be having less and less and less to spend. So it needs to be a balance. And once you set the strategy, then you need to stick with it. So
Interesting. Mm-hmm.
The people that lost money, really, in the 2008 sell-off, I think, are the people that abandoned the strategy, or they never had a strategy to begin with.
Mm-hmm.
So they saw that the stocks were going down in value, and they sold.
Mm-hmm.
And so now they ended up losing twice. They lost when the money went down, and they lost while the market recovered, and they were still sitting in cash, wondering when to get back in. And cash isn't paying anything. But the people that had a strategy, and how this works is, let's say that we have, just to make this simple, 50-50. So half of our money is going to be in stocks and half of our money is going to be in bonds. We do not try to time the market. We do not try to determine that the president's policies are going to wreck the country, so we're going to get out of stocks, or that the market's going to take off and because it's undervalued and here's the time to put everything into stocks. We're going to maintain that balance of 50-50 and let the market tell us when to sell. So when the stocks go up in value, and they typically outperform your bonds, you're going to be overweighted in stocks most of the time, and you're going to take those opportunities to sell off part of your stocks to bring yourself back into balance. Mm-hmm. Maintaining the 50-50, which forces you to harvest off your gains as you're making them, and you're constantly selling high, selling high, selling high. And then when the market drops like it did in 2008, now you're flip-flop. Now you're overweighted in bonds because your stocks just have shrunk by 30 or 40%, and your bonds have maintained their value. Now you're overweighted in bonds, and that's when you sell some of your bonds to buy stocks to bring you back to 50-50, which is forcing you to buy low. Now, it's easy to say, especially now that the market's got back to almost 11,000. It was very difficult to do, but it was the right thing to do. And if you have that strategy in advance, and you know that you're going to follow that strategy, even though it doesn't feel right, even though the financial press might be telling you that, it's going to get worse, it's going to get worse, it's going to get worse, and they'll continue to say that even after the market has recovered 30 or 40%. You're buying low, selling high, letting the market dictate it, not letting your emotions overtake you, because you're following a strategy that while we're calm and we're thinking unemotionally, hopefully, if there's such a thing, that we've determined that 50-50 is the right balance.
I know it's interesting, too, Rick, is that on our program we've had former daughter-in-law Mary Buffett on our program, Warren Buffett's daughter-in-law. So we've brought up, how to approach what you're talking about here with stocks and getting people to understand better what they are, which is owning a piece of a company. And it's really amazing how people, when they get into investing in stocks in the market, that they actually follow their emotions. And those people tend to lose quite a bit versus using some common sense and some good planning, as what you're talking about. She actually talks about at length as well, about understanding what you're investing in. These are good companies that have a unique edge. No matter how good or bad the times are, they're going to just be continuing in business no matter what. For instance, like Coca-Cola. Right. So you can see how you can exercise some really good common sense by just looking into the matter and understanding it better, and then exercising, as you're talking about, a good balance. When things are, when they're at a high point, you sell some of that off to drop that down a little bit and put it into something else. So you're really managing, your retirement portfolio. Very, very, very good advice. And
not letting the market panic you out. And that's unfortunately what a lot of people do. And they continually buy high and sell low, which is not a very successful investment strategy at all. And it's because of emotions.
As she was telling, I was going to say, as she was telling me just real quickly, she says, General Electric, and this was like 2 months ago, is selling at $6 a share. She says, that's when you want to be getting in. General Electric's not going anywhere,
I think what people need to remember is that, and it's what I love about stocks, is that these are companies that are constantly changing and adapting and making adjustments. And so when the financial crisis was reaching the boiling point in the fourth quarter of 2008, and people were panicking out of stocks because the country was coming to an end, or whatever disaster du jour that was being spread at the moment, companies were adapting to that. Now, one of the ways that they adapt is they cut heads. And, of course, unemployment, so-and-so is laying off, so-and-so is laying off. But what they were doing was keeping themselves profitable. And really, it's profits that drive stocks. I mean, what makes Coca-Cola worth more? Well, they increase their profits. How do they do that? Well, they keep getting more efficient at what they do, or they come out with new products, or they expand into new markets. They constantly change and adapt and change and adapt and change and adapt, which is why they can continually grow their profits. And
which, interestingly enough, you might agree with, too, is that these are companies that in some ways not only understand, but even in some ways recreate the rules when the government intervenes.
Right. That's right. And so, I mean, one of the things that you hear about is the healthcare reform. Well, it's going to be awful. It's going to be awful for these people. It's going to wreck our economy. It's going to wreck companies because it's going to cost them more money. They're not going to be profitable. We should all get out of stocks because this is going to be a disaster. I'm not saying that's my opinion. I'm just saying you hear that from people who are looking for reasons to sell their stocks.
Right.
But in reality, what will happen is companies will figure it out, and they'll make adjustments, and the stock market will do 10% again, just like it does year after year on average, produce a 10% return. So about 6 or 7% over inflation, which is what it's done for the last 200 years.
I think what's really interesting, over the 6 years we've been doing our program is that we have tried to move out of the conventional wisdom that you typically see espoused to show different ways that you can look at something, for instance, like retirement and investing. And, it's really great when, you're kind of moving in that motion and you're starting to do the right strategies, and then you have a book like yours that comes along and says, okay, now let's see how we can maximize what you get to keep as you're starting to use it at a time that you need to use it. Could you tell people what is the best way for them to get a copy of your book?
Well, it's available on all bookstores and on Amazon or on Barnes & Noble. Probably the best way to get it, though, is on the book has its own website. You can buy it right off the website. That's thenewthreelegedstool.com. Because if you buy it on the website, then you're also automatically signed up for the monthly updates. Because as we're all aware, tax law is constantly changing. We just had another big change as part of the healthcare reform. There'll be other changes. And so as tax law changes, I'll continue to update the strategies and the techniques to be used to implement the three-legged stool method of planning for retirement. And so you'll automatically get those updates.
The book is The New Three-Legged Stool, A Tax-Efficient Approach to Retirement Planning, and our guest today, Rick Rogers. Thank you for joining us here on the program today. It's been a pleasure.
Thank you for having me.
You bet. I'm Daniel Davis. Thank you for joining us. You've been listening to the Beyond 50 radio program. Be sure to visit us at our website at beyond50radio.com and sign up also for our free weekly e-newsletter as well as visit our blog. Thank you again for tuning in. Remember, live your day past halfway.